Welcome everyone to another session of Mission Yeshas. Hope you are doing great and your revision is going on at full force. So today we'll be covering a very important concept from where significant number of questions are asked, and sometimes these questions becomes really confusing if your concept related to cost is not clear. So today in this we will cover the theory of cost. Now, it is very important for any business to manage its cost because too much of cost escalation will lead to significant reduction in the profitability of the company. There are different types of cost: fixed cost, variable cost, direct cost, indirect cost. So, you see, direct cost is the cost that is directly attributed to any particular commodity that people buy or people that the company makes. So it means if, let's say, Hindustan Unilever is making a shampoo bottle, the cost of material, the cost of electricity consumed by the machinery in the factory, the wages to the labor, they all are direct cost. But management of the business, advertisement cost, these costs are overall general costs. So these are indirect cost. So direct cost can be attributed to a particular product, whereas indirect costs cannot be linked to any particular activity or any particular product or services. Now, we know the concept of fixed cost and variable cost, but we need to understand the logic behind why any cost increases or decreases. So, here let's figure out, if we write here quantity and let's say 0, 1, 2, 3, 4, 5, 6, 7, and 8, and if I take total fixed cost, all right. So, what is total fixed cost? Business do not incur only one type of fixed cost: rent on the building, salary, all right. All these costs are electricity, fixed electricity charges, insurance premium, interest on capital. These are all fixed costs for a business. Whether production increases or decreases or it becomes zero, the same amount of fixed cost will be incurred by a firm. Even when the output is zero, I have to pay the rent on or the lease on my factory premises. So let's, if I take rupees 1000 is the fixed cost. So whether it's zero output or output is 1 unit, output is 2 unit, output is 3 unit, or whatever it is, the total fixed cost remains same, right? So if I have to make a TFC curve, so don't you think the TFC curve, first of all, I'll hit on the points from where they can ask you the question. If I take fixed cost along the y axis and output along the x axis, now, can a fixed cost curve begin from the origin? If it begins from the origin, it means you are saying that when output is 0, TFC 0. That is not a possibility, correct? So, it will begin from a point along the y axis. But again, can it increase or can it decrease? If that is the case, then with, you are saying with the increase in output, the fixed cost is decreasing, or with the increase in output, the fixed cost is increasing. Again, that is wrong. So, it means it will be a flat line. This will be your TFC curve. Why? Because whether the output is 0 or output is 1 unit, 2 unit, 3 unit, 4 unit, whatever it is, the total fixed cost remains constant. So the TFC curve is a parallel line which is parallel to the x axis, that is the quantity axis, and it touches the y axis. Whether output increases or decreases, it remains same. That's why it doesn't begin from the origin. Right. Then if we talk about total variable cost, TVC. Now we have learned that total variable cost initially it will increase at a decreasing rate and then it will increase at an increasing rate later on due to law of variable proportion. So if suppose if I'm making 1 cup of tea, my fixed units are the oven in which I'm making the tea, the kettle in which I'm making the tea on, right. So the oven that I'm using upon which the kettle is kept and I'm making the tea in the kettle, so these are all fixed. But what is variable? Water is variable, milk is variable, sugar is variable, tea leaf is variable. Now let's say if I'm making 1 cup of tea and I'm incurring 10 rupees, when I make 2 cups of tea, will I incur 20 rupees? The answer is no. I'll incur more than 10 but less than 20. Why? Because when I made 1 cup of tea, I did not fully utilize the potential of the fixed input, and also did not fully utilize the potential of the variable input. For example, to make 1 cup of tea, I may require 1 tablespoonful of tea leaves, but to make 2 cups of tea, I may require just 1.5 teaspoonful. And moreover, I use 10 minutes of LPG, that is the cooking gas, when I made 1 cup of tea. But when I make 2 cups of tea, do I need to boil it for 20 minutes? No, 15 minutes would be fine. So it means then that what happens here, when the output is 0, TVC will be 0. When I'm not producing, why will I buy any variable input? And let's say when I making 1 unit, the total variable cost is 200. So it means for 1 unit it increase from 0 to 200. But when I'm making 2 cups of tea, it increases to 300. So it means it is increasing by only 100. It is increasing at a diminishing rate due to better utilization of resources. When I am producing third unit, it may increase to, let's say, 360. It is increasing by only 60 rupees. When I am making 4 cups, it is increasing to 400. That is only by 40 rupees. But what will happen? Let's say if the kettle is there and you can make 5 cups of tea, and you are already making 4 or 5 cups of tea. Now, don't you think due to large quantity, you have to be very careful? You have to constantly simmer and put it in high flame simmer, because if you don't do that, it will spill. So there will be a losses will start to mount up due to evaporation and this and that. That the same logic is applicable in every business. Whether the beauty of economics is that whether you are making a tea in the kitchen or somebody is making something in a machinery in a factory, the logic remains the same. So if you are producing less quantity, then you are underutilizing the potential of your fixed input. Your cost will be little higher. But as you increase your output, your costs do not increase in the same proportion due to better utilization of fixed input. And once you better utilize your fixed input, it means your variable inputs are also optimally utilized. But how far can it go? What if I try to make 5 cups of tea in a kettle that can help me make, say, 4 cups of tea? Don't you think spillage will happen, losses will increase? So it means after a certain point in time, the total variable cost will begin to increase at an increasing rate. You see, it increased from 600 to 400 to 600, that is by 200. Previously, it had increased by only 40. Then it may increase to 1000, that is, it is increasing by 400. Then it may increase to 2000, that is, it is increasing by 1000. And then it may increase to 4000, that is, it is increasing to by 2000. So what is happening here? So initially TVC increases at a diminishing rate, then it begins to increase at an increasing rate. So if I plot it into a diagram, how would it look like? This is your variable cost and this is the output. So for 1 unit, for the first unit, I incurred 200 rupees. For the second unit, I incurred 300 rupees. For the third unit, I incurred 360, increases only by 60 rupees. For the fourth unit, it increases just to 400. For the fifth unit, it increases to 600. For the sixth unit, it increases to 1000, and so on and so forth. So if I plot this into a diagram, how would it look like? So let me draw the TVC curve diagram, TVC curve rather. It is in the form of inverted S shape. So this is your TVC curve. Alright. So initially it increases at a diminishing rate, and then it increases at a increasing rate. It rises sharply due to law of variable proportion. Now, if I want to figure out what is my total cost, total cost is nothing but summation between total variable cost and total fixed cost. So if suppose if I want to find out what is my total cost, That will be total variable cost plus total fixed cost, correct? But when we produce 0 unit, your total variable cost at 0 unit is 0, but your total fixed cost cannot be 0. So can we say that at 0 unit of output, your TC will be equals to TFC only at 0 unit of output? So let's see here. If I want to figure out what is my total cost, that is total fixed cost plus total variable cost, 1000 plus 0 is 1000, then 1200, then 1300, then 1360, then 1400, then 1600, then 2000, then 3000, and then 6000. So total cost also increases first at a diminishing rate and then at an increasing rate. But understand this thing here. Total cost, it doesn't have its own identity. Total cost is simply a summation between total variable cost and total fixed cost. And total cost cannot be 0 because total fixed cost cannot be 0. Correct? Total cost cannot be 0 because total fixed cost cannot be 0. So TC and TC curve and I will start from the same point as the TFC curve. But the rate of change in the total cost curve, total cost is exactly like total variable. If I ask you if there is increase in the total cost or decrease in the total cost, if suppose total cost increases or decreases, is it increasing or decreasing due to total fixed cost? No, total fixed cost is constant. So it is going to change by as much as the change in the total variable cost, because total variable cost is bringing about the change in the total cost. So the shape of the total cost curve will be exactly like the total variable cost curve. And you see here that total cost is changing by the same margin as the total variable cost, 1000 to 1200, 200. Do you see 200? 1200 to 1300, that is by 100. So you see it is increasing by 100 only. If you take this one, 1400 to 1600, that is by 200. Here you see by 200, because the difference between them is due to fixed cost, and fixed cost is do not changing. So total cost will change by as much as the change in the total variable cost. So if I have to draw the total variable cost also, we'll draw the combination of all three together. So this is your cost and this is the output quantity. This is your TFC curve. This will be your TVC curve beginning from the origin, and this will be your TC curve, total cost curve. Now you see how to interpret this diagram. Let's figure it out. When output is 0, then TC and TFC are same. So let's say in our case is starting by 100,000 rupees. When output increases to 1 unit, total variable cost is 200 and total fixed cost is 1000 plus 200, that will be 1200 over here. When the output increases to 2 unit, total variable cost increases to 300, total fixed cost is still 1000, 300 plus 1000, so you will get 1300 rupees. Likewise you can interpret the diagram. Moreover, you will find that the frequently asked question is that TC and TVC curve are parallel lines. You see the gap between them always remains constant. And what is the reason? The reason is due to the total fixed cost. Because the difference between the TC and TVC will be always 1000, which is due to the total fixed cost, and that's why they will be parallel lines. Even if you see in the table, the difference between the TC and TVC is always equals to 1000. You see, always equals to 1000 is the difference. All right. Clear. Now let's come down to the concept of average. So first, average fixed cost, AFC. Now average of any cost is the total of that cost divided by the level of output. So if I have to figure out what is AFC, then TFC I'll divide it by output, correct? So what is happening is that your numerator remains constant, But as output increases, the denominator, that is the quantity, is going to increase. It means you are dividing the same numerator by increasing denominator. So don't you think AFC will continue to fall down? So let's go here and see in the table. Now remember, we are dividing total fixed cost by output. So you cannot divide 1000 by 0 and write infinite here. So either you'll write 1000 here or simply you put dash over here. Our concern begins from here. So 1000 by 1 is 1000. 1000 by 2 is 500. Then 1000 by 3 is 333.33. I'm ignoring the decimal. 1000 by 4 is 250. 1000 by 5 will be 200. 1000 by 6 will be 166.66, 167 ले लेते हैं. Then 7 one times, 7 two times, and then 6, 7, 8, 128 something. Then 125. Correct. So now what is happening? You see that in many books you'll find that the AFC curve they've given is, of course, downward sloping. But this is a wrong diagram. Why? Because you see, you are saying that where your cost was 1000, it fell down to 800, then it fell down to 600 as output increases from 1 to 2 to 3 unit. No, it doesn't fall in this way. This is wrong. So we'll see that mathematically, when you keep the numerator constant and go on increasing the denominator, initially the fall will be very sharp and then the fall will slow down. It will still fall, but it will slow down. So you go to the table and see, initially the fall is sharp from 1000 to 500, that is by 500. Now the fall is by only 167, and if you come down here you'll find that the fall is not even equals to 50 rupees, not even 50 rupees. All right. So it means if I have to draw the AFC curve, how do you think it will look like? So average fixed cost, and here's the output. So initially how much is it? 1000 to 500. So first unit you're producing 1000 is your average fixed cost for one unit. For second unit it is falling down sharply to 500 for the second unit. Then it falls down to 333. Then it falls down to 250. Then it falls down to 200. The fall slows down. This way it will be interpreted. And now if I join these points here, you'll find that this is a downward sloping curve. It is convex. This is your AFC curve. So first of all, AFC is a downward sloping curve. Why? Because with the increase in the output, the average fixed cost decreases. It is convex to the origin. Why? Because initially the fall is very sharp, then the fall tapers off. But can it ever touch the x or the y axis? No. If it touches the y axis, it means you're saying you're dividing the total cost by 0, total fixed cost by 0 to get an infinite value. No. And it can never touch the x axis. Why? Because even if I'm producing 10,000 units here, 10,000 unit, so it means 1000 divided by 10,000, you'll get 0.1 value. So it can become negligible, but it can never become 0. So AFC curve can never be 0 and it will never touch either the x or y axis. Then comes what is known as AVC curve. So if I have to figure out what is AVC, as I've told you, the average of any cost is total of that cost divided by the level of output. So it means if I want to find out what is my AVC, I have to divide TVC by output. Correct. So what happens here, you will find that when total variable cost increases at a diminishing rate, if any cost increases at a diminishing rate, its average will fall. And when that cost increases at an increasing rate, its average will rise. So it will become a U-shaped curve. So if I have to draw what is known as AVC, AVC curve. So here TVC is 0, so this will be 0. 200 by 1 is 200. 300 by 2 is 150. 360, that is 120. Then it will be 100. then it will be 600, 5, 120 again, then it will be 167, then it will be 2000 by 7, that will be 7 2 times, and 7 8, and 7 5, 285, you can say, and then 500. Clear? Got it? So what is happening here? You see, initially as the output is increasing, ABC is falling down 200 to 150 to 120 to 100, and then begins to rise 120 to 167 to 85 and 500. So can we say that the ABC curve, this is your average cost or average variable cost, also you can write quantity. This is your ABC curve, right? As the output increases, initially it decreases, it reaches its lowest value, then it begins to rise up again, U shape. So if any curve is U shape in the short run, remember it is law due to law of variable proportion that I've explained, uh, you know, through the total product diagram. If you want to uh, understand it more, you can refer the marathon sessions given in the description. So this will be a U-shaped curve. So ABC will be a U-shaped curve. Now, if I want to figure out what is my average total cost. Now remember, average total cost you can get in two ways. Average total cost you can get either by adding average fixed cost plus average variable cost, or you can get average total cost by dividing the total cost by output. Clear? So let's figure out what is happening to average total cost. So you see, it means we are adding this AFC plus AVC equals to ATC. So here 1000 plus 200, that is 1200, then 650, then 354, 453, then 350, then 320, 334, then it will be 413, and then it will be 625. Clear? So what is happening? You will find that ATC curve also initially falls, it reaches its lowest point and then begins to rise. So remember, it doesn't matter which average you're talking about. If the total is increasing at a diminishing rate, then average will fall. And if the total is increasing at an increasing rate, then the average will rise. Always it will happen. So can we say in case of AFC curve also, it falls down, reaches the lowest point, and then it rises up. So very similar diagram you will get in the ATC curve as well. This is your ATC curve. Again, this will also be U-shaped. Initially it falls and then it begins to rise. Now they ask you a lot of questions with regard to relationship between ATC and AVC curve. So let's say for example, if I draw both the curves together, and you know where they will try to confuse you? They will try to confuse you between the total and the average. So here is your average cost and here is the quantity of output. Now this is your ATC curve and this is your AVC curve. Now unlike TC and TVC curve, which were parallel lines, you see here TC and TVC curve were parallel lines. Why? Because the difference between them was TFC and TFC was constant. But does AFC remains constant? No. You see here what happens to AFC? AFC is continuously is falling down. Just look here, AFC is continuously falling down, but TFC is remaining constant. Clear? So the difference between ATC and AVC is AFC. So if I say that ATC is AFC plus AVC. And don't you think as output increases, AFC continuously falls? Correct. When AFC is continuously falling, can I say the difference between ATC and AVC will continue to fall also? So don't you think these two curves will come closer to one another? So that's why you see there is a big difference before. All right. But as output increases, the difference starts to squeeze. These two curves come closer to one another. AF because as output increases, AFC decreases, and that's why they come closer to one another. But they will never touch. Why? Because AFC cannot be zero. So remember TC and TF, total cost and total fixed cost. Total cost and total variable cost, they are parallel line because the difference between them is total fixed cost that never changes. But ATC and AVC curves are not parallel line because the difference between them is AFC, and AFC continues to fall as output increases. Then comes the concept of marginal cost. So remember, if I have to calculate marginal cost, then I have to find out change in total cost by change in output. Marginal cost shows how much will be the change in the total cost when output changes by 1 unit. So marginal cost, if I want to find out, so total cost, what is the change here? Nothing. Now the change here is 200, then the change here is 100, then the change here is 60, then the change is 40, then the change is again 200, then the change is 400, then the change is 1000, and the change is 3000. So marginal cost also initially fall and then rises. So marginal cost will also be a U-shaped curve. Marginal cost and output. So marginal cost will also fall and rises sharply. Now they always ask you the relationship between ATC, AFC and ATC, AVC and MC. You'll find here, you see AVC and MC, they start from the same point. Then what happens? You see MC is falling and AVC is also falling. So it starts, both start from 2. AVC falls to 50 to 120 to 100. It's falling down. All right. But MC falls from 200 to 100 to 60. And you see, after reaching the lowest point, AVC begins to rise, and by the time it rises from 100 to 200, what 100 to 120, what happens during the same time? MC rises from 40 to 200. It means, can I say AVC and MC both are falling, and when AVC is turning around and it rise, by the time it rises from 100 to 200, MC rises from 40 to 200. It will cut AVC from below from its lowest point. The same logic you'll find in case of ATC. So you see MC and ATC, they both are falling, and MC curve begins lower than the ATC curve. So it falls, the ATC falls down from 1250 to 650 to, you see, 453, 350. You see the chart here. So, and from where it begins to rise? It begins to rise from this point. So what happens by the time ATC rises from 320 to 334? What happens to MC? MC rises from 400 to 200. So don't you think MC will cut the ATC curve also from below from its lowest point? So if I have to draw all the three curves together, can I say here average cost and marginal cost, and here is the output. So first we'll draw MC curve. It will become easier to draw the remaining two curves. This is your MC curve, and this is your ABC curve beginning from the same point, and this is your ATC curve, ATC curve. So the gap between ATC and AVC is narrowing because of AFC, we know. But what you need to figure out here, MC curve cuts both ATC and AVC curve from below from the respective point. And we can say that when ATC and AVC curve has negative slope, between they both are falling during that time, can we say that ATC and AVC, when they are falling, then MC will be less than ATC and AVC? And can we say here that when ATC and AVC has a positive slope, it means when ATC and AVC are increasing, then MC will be more than ATC and AVC. And of course, MC curve cuts both ATC and AVC curves from below from their respective minimum or lowest point. I hope this session helped you understand the concept of cost. Now, please go back and solve all the questions MCQs in the ICI exercise book. It will help you get an idea about the pattern of question they ask in the examination and what kind of complexities they create, right? Till then, we will, continue with the account session, and this mission Yeshas will continue to cover many other topics later on. Please do not forget to write in the description cost and wait, because accounts is going to start soon. Wish you all the success in life. Yashashi Bhava.
Let's go ahead. Mission Yashas continuing for all of us. We are discussing the chapter of depreciation. Depreciation chapter I will divide under three categories, calling them as yesterday, whatever we discussed, methods of calculating depreciation, accounting for fixed assets and depreciation, what I'm going to discuss in tomorrow's class, and then we have some miscellaneous topics, which is our target for today. Under the miscellaneous topics, important ones which I want to discuss are going to be change in life of an asset, change in estimated useful life, change in the method of depreciation, revaluation of assets, and depreciation on revalued assets. Apart from this, your target for today should involve topics of amortization as well. Let's come down to the first one which I want to discuss, change in method of depreciation. For looking at change in method of depreciation, I want you to look at ICI practice question. Look at practice question, or rather I should say illustration number 10. Let's come down to illustration number 10 of ICI material itself, page number 5.24. Mrs. Anshul commenced a business on 1st January 2017 when they purchased plant and equipment for 7 lakh. The value of M1 machine 1 is 7 lakh rupees, which was purchased on 1st January 2017. They adopt policy of charging depreciation at 15% per annum on diminishing balance basis. They are already following WTB method, diminishing balance basis, depreciation at the rate of 15%. Over the years, their purchases of plant have been as follows. 1st January 2018, 1,50,000, which I am calling as M2. 1st January 2021, 2 lakh, which I am calling as M3. Machine 1, machine 2, machine 3. On 1st January 2021, it was decided to change the method and the rate of depreciation to straight line basis. Till now, they were following diminishing balance basis, that is nothing but written down value method. Now they want to go ahead to follow straight line method. On this day, the remaining useful life of the was assessed as 6 years for all the assets purchased before 1st January. Old assets are having a life of 6 years with no scrap value, and it was 10 years for the asset purchased on 1st January 2021. For the new asset, the life is going to be 10 years, and for the old assets, the remaining useful life is assessed as 6 years. They're asking you below that required calculate the depreciation to be adjusted in the profit and in the plant and machinery or plant and equipment account for the year ended 31st December 2021. Calculate depreciation for 2021 is the requirement of the question. Let us first see whether change in method of depreciation is allowed or not. For this, I am referring to the classroom notes. Whether you have taken classes from Yeshas Academy or anywhere else, you can look at your class notes for discussing what happens when there is change in method of depreciation. The method of depreciation chosen should depend on the expected pattern of usage of the asset. If it is expected that the asset will be used equally throughout the life of the asset, then depreciation also should be given equally. In that case, you will follow straight line method. However, if due to the nature of the asset, it is expected that the usage of the asset will reduce throughout the life of the asset, appreciation also should reduce throughout the life of the asset, and then you will follow written down value method. The usage of the asset should be reviewed at the end of every year, and if there is a significant change, the method of depreciation also should reflect such change. The method of depreciation depends on the usage of the asset. Usage of the asset is an estimated number, estimated item. It can change depending on facts becoming available. So you expect to use the asset equally, then you were following straight line method. But you got to know now that the usage of the asset is going to reduce. You need to change and follow WDV method. The usage of the asset should be reviewed at the end of each year, and accordingly, your method of depreciation should also be reflected. It is treated as a change in accounting estimate, and the same should be disclosed in the financial statements as per the relevant accounting standards. So basically, they are saying usage of the asset is an estimated item. If the usage of the asset changes, your method of depreciation should also change. Based on this, let us go ahead to calculate requirement of the question depreciation for 2021. There are three machines. We'll start with the working note. I'll start with calculation of depreciation. We have three machines, so I will say particulars: machine 1, machine 2, and machine 3. As a part of the solution, the first item I always prefer to write is the date of acquisition of the machines. So let us look at the question and record the date of acquisition. Machine 1 is acquired on 1st January 2017. Machine 2, 1st January 2018, and machine 3 is on 1st January 2021. We are following calendar year in this question. That means my relevant year for calculation will start from 2017. I start with the calculations for 2017. I will start with cost of the first machine. What is the cost of first machine directly given in the question? 7 lakh. There is no purchase or sale during this particular year, so I will directly say depreciation for 2017. Depreciation for 2017 can be calculated as 7 lakh into what they were originally following. They were originally following 15% depreciation under diminishing balance basis. So I will say 7 lakh into 15%, which gives you depreciation of 1 lakh 5,000. Once you record this depreciation, you get the WDV of the respective asset. You will calculate WDV of the asset as on end of 2017, or you can say 1st January 2018. 7 lakh minus 1 lakh 5,000 will give you 5 lakh 95,000. Let's come down to 2018. In 2018, there is a purchase of the asset. So I will start by saying add cost. M2 column, the cost of machine 2 given in the question directly 1 lakh 50,000. There is no other purchase or sale in the year 2018. I record depreciation for 2018 WDV method 5 lakh 95,000 into 15%. For M2 1 lakh 50,000 into 15%. There is no time period over here because both the assets are purchased on 1st Jan, so we give depreciation for entire 12 months. 5 lakh 95,000 into 15% gives you 89,250. 1 lakh 50,000 into 15% will give you 22,500. Once you record this, we will go ahead to see what is the WDV at the end of second year. You get WDV as on 1st January 2019. 595 minus 89,250, 5 lakh 5,750. M2 1 lakh 27,500. We have come down to 2019. I think in 2019 there is no other transaction. 19 and 20 there is no transaction. 2021 we have a purchase. So for 2019 I can directly go ahead to say less depreciation for 2019. M1 5 lakh 5,750 into 15%. M2 127,500 into 15%. Your depreciation respectively comes to how much? Please calculate and let me know. So your depreciation of M1 will come down to 75,863 and M2 will be 19,125. Based on this, let us calculate WDV as on 1st January 2020. In the year 2020, M1 WDV comes down to 429,887 and M2 is 1,08,375. Again, 2020, there is no other transaction, so I will directly say less depreciation for 2020. Written down value method 429,887 into 15% and 1,08,375 into 15%. Respective depreciation is how much? 64,483 if I am not wrong, and 16,256. We will calculate WDV as on 1st January 2021. WDV as on 1st January 2021. 2021 is the relevant year in the question. We have M1 equal to 3,65,404 and M2 is 92,119. Let me just check this calculation. 429,887 minus 64483. 365,404. Yes, correct. Okay. And we have come down to 2021. In this year, I'll start by saying add cost of M3. Cost of M3 was given in the question. The value of M3 is equal to 2 lakh. I directly go ahead to say depreciation. Depreciation for 2021, they want to change the method. In this particular year, instead of following written down value basis, they want to now change and follow straight line basis. For following straight line basis, they have not given you a rate of depreciation, but they've given you the life, estimated remaining life of the assets. M1 365,404, the remaining balance will now be depreciated for 6 years. M2 92,119 will now be depreciated for 6 years. What about machine 3? 2 lakh cost of the asset. Scrap value is not given for any of the items, divided by remaining life of 10 years. Going back to the question to identify, old assets have a life of 6 years and new assets having a life of 10 years. You get depreciation for the respective assets as 60,901, 15,353 and 20,000 respectively. Then we will calculate WDV as on 1st January 2022, which you get as 3,04,503 for M1, 76,766 for M2 and 1,80,000 for M3. This is your depreciation for the required years. I'm going ahead to calculate for one more year. What if the question says calculate depreciation for 2022? Now from 2021 onwards, they are following straight line method. So what will be your depreciation in this case? It will be 60,901 for M1, 15,353 for M2 and 20,000 for M3, subject that that asset is not sold in the relevant year. Based on this, the question had asked us to calculate depreciation for the relevant year. So we have calculated depreciation for 2021 will be the total of M1 plus M2 plus M3. 60,901, 15,353 and 20,000 respectively, which I think should be giving you around 96,500 sorry 96,254. This is your depreciation for year 2021. Change in method of depreciation depends on the usage of the asset. If the expected pattern of usage of the asset changes, in that relevant year, you can change the method of depreciation of that respective asset. If I look at the answer of ICAI, they have prepared plant and machinery account. They've started with the opening balance. They've recorded the purchase of the asset. Depreciation similar 96,253, 1 rupee rounding of error, and then they've recorded the closing balance of the asset. Students might get confused. Sir, where do we get this 457 523 opening balance? You get it in your working note itself. I am marking in green color on the screen. WDV on 1st Jan 2021. WDV of M1 plus M2 will give you the opening balance in your machinery account. If they've asked you to prepare machinery account, then you will prepare. If the question just says calculate depreciation, stop at the calculation itself. We completed the first target for today, your change in method of depreciation. Let us look at one more concept. What happens in case of change of life? For change of life, I want you to look at the next question itself. Look at question number 11. Again, we are going ahead for ICI material itself. Illustration number 11. Let's read illustration 11 together. A machine costing 6 lakh is depreciated on straight line basis, assuming 10-year working life and nil residual value for 3 years. The estimate of remaining useful life after third year was reassessed as 5 years. Now, my dears, if I draw a timeline, original estimate of life is 10 years. They are saying we use the asset for 3 years. So after 3 years, what should be the remaining life? The remaining life should be actually 7 years. But they are saying the remaining useful life was reassessed to be 5 years. The remaining is just 5. Total life of the asset becomes 8. What you originally thought that you will use the asset for 10 years, you're able to use only for 8 years. This is called as change in life of the asset. Of course, useful life is an estimated item. It can change depending on facts becoming available or the assumptions taken. Useful life is an estimated number. You estimate the life based on certain assumptions or based on certain facts which are available at that point of time. You expect to use the asset for 10 years, but then as you are using the asset, you got to know the quality of the asset is not very good. You can use it for lesser period of time. So therefore now the remaining life is 5 years, total being 8. Calculate depreciation for the fourth year. First of all, what are we going to do in case of change in life of the asset? Let us look at the theory first. Useful life is an estimated number and may change depending on assumptions taken or facts becoming available. The residual value, scrap value, and useful life of an asset should be reviewed at the end of each financial year. And if there are any significant changes, these changes should be accounted for as a change in accounting estimate. Okay, sir. They should be disclosed in the financial statements as per the relevant accounting standards. But for accounting, for calculation purpose, what is important? The unamortized amount. What do you mean by the unamortized amount? Unamortized amount not depreciated. Basically, the WDV of the asset will now be depreciated over the remaining useful life. Let us go ahead to calculate for this particular question. In this particular question, I will say the cost of the asset. What is the cost of the asset? The original cost is rupees 6 lakh. The scrap value of the asset is given as nil. What is the life of the asset? The original life is 10 years, but then we are seeing after 3 years there is a remaining life of just 5 years. The remaining life is 5 years. Yes. In this case, how will you calculate depreciation? Depreciation for first 3 years is going to remain same. What is the formula for depreciation? Cost minus scrap divided by life. The change in life happened at the end of 3 years. So for first 3 years it is going to remain the same. 6 lakh minus 0 divided by 10, which will give you rupees 60,000 depreciation per annum. Because the life is given in number of years, your depreciation is per annum. Okay. What will be your WDV or book value at the end of year 3, cost of the asset 6 lakh minus year 1 depreciation 60,000, year 2 depreciation 60,000, year 3 depreciation 60,000. So your WDV of this asset will be 6 lakh minus 1 lakh 80,000, 4 lakh 20,000. What should I do with 4 lakh 20,000? Now 4 lakh 20,000 has to be depreciated over remaining useful life. So your depreciation from year 4 onwards will be equal to 4 lakh 20,000 divided by remaining useful life of 5 years. Depreciation is equal to 84,000. If a common man reads, he's seeing that the depreciation for first 3 years is 60,000 and year 4 onwards is 84,000. What comes to his mind? Depreciation has increased. That means this organization has purchased some new asset. No, depreciation increased not because of fixed asset increased. Depreciation changed because of change in useful life. Whenever you have such a situation, the fact should be disclosed in your financial statements for proper understanding for the users. They should not feel that depreciation has gone up because of new assets being purchased. Depreciation has gone up because useful life went down. That remaining 4,20,000 cannot be depreciated for 7 years. It will now be depreciated for 5 years. The remaining or the unamortized WDV of the asset, the unamortized amount of the asset, will be depreciated over remaining useful life. We completed change in method of depreciation and change in useful life of an asset. Let us come down to the next topic, revaluation of an asset. Please remember, revaluation of a fixed asset can be in two ways. You could have an upward revaluation, or you could have a downward revaluation. Upward revaluation, of course, fixed asset account is going to be debited. Downward revaluation, of course, your fixed asset account is going to be credited. Yes, sir. What is the other effect that I am going to give? Upward revaluation, fixed asset account debit to revaluation reserve account. Downward revaluation, profit and loss account debit to fixed asset account. Sir, upward revaluation goes to revaluation reserve. Downward revaluation goes to P&L. Why, sir? Simple conservatism concept. What does conservatism prudence say? If you're expecting a future loss, take it to your P&L account today. If you're expecting a future profit, wait for the profit to actually happen and then only recognize your profits. Expected losses can be provided for, anticipated gains cannot be recorded. Upward revaluation, you expect to have a gain, don't take it to your P&L account, record revaluation reserve. Downward revaluation, you're expecting a loss, take it to your P&L account immediately. In this entry, we also have a sub point. I will go ahead to say upward revaluation normally should have been FA to RR, fixed asset to revaluation reserve. But here I will do fixed asset account debit to P&L account and then to RR. What is this P&L account, sir? Only to the extent of previous reversal. If you are doing a first time revaluation upward, directly say fixed asset to revaluation reserve. Sir, previously we had done a downward reversal. I want to change that. Then previously you would have done PNL to FA. Now you change it, you reverse it, record FA to PNL to the extent of previous reversal, and then any balance can be taken in your revaluation reserve account. Similarly, downward, when I am recording downward, I will not take directly PNL to FA. I will take revaluation reserve account debit to FA. Revaluation reserve account kitna? Only to the extent of previous reversal. Previously you would have recorded FA to RR. Now you record RR to FA. To the extent of previous reversal, you take FA or PNL, I mean RR or PNL, and then you take the balance amount. To understand this better, let us look at one question. There is one question in the practice questions of your ICAI. I want you to come down to question number 5. Practice questions, question number 5. I am referring to ICAI practice question number 5, which is on page number 5.40. 5.40, we are referring to question number 5. Let's read through the question. What the question is saying. Amazing Group had property, plant and equipment with a book value of 35 lakh. The book value of the asset is 35 lakh. On 31st December 2022, balance in revaluation surplus on that date is 3 lakh. That means previously we have already done a revaluation and there is 3 lakh sitting in revaluation reserve account. Revaluation surplus can also be called as revaluation reserve account. Previously, there was an upward revaluation of 3 lakh which is sitting in revaluation account. As a part of their practice of revaluing the assets on yearly basis, another revaluation was carried out on 31st December 2022. Evaluate the impact of revaluation if the fair value as a result of revaluation done on 31st March was 37 lakh, 33 lakh and 31 lakh and give the respective journal entries. The book value of the asset is 35 lakh. If I come down to case A, the book value of the asset is 35 lakh. The revalued amount is equal to how much? 37 lakh. Now, in this case, what is happening? It is being a revaluation upward. Sir, previous also was upward. Your second time revaluation is also upward. Can I directly take it to fixed asset account? Yes, sir. Can I directly take it to revaluation reserve account? Yes, sir. So I will record fixed asset to revaluation reserve 2 lakh, 2 lakh. Original amount 35 has now become 37. Your revaluation reserve, which was sitting at 3 lakh, will now become 5 lakh. No problem at all. Let's come down to case B. Case B, book value of the asset was 35 lakh itself. Your revalued amount is given as how much? Revalued amount is given as 33 lakh. In this case, revaluation is going upward or downward? It is going downward. When it is going downward, is it the first time or the second time? It's the second time. So why are you saying second time? There is already revaluation reserve in your accounts. That means previously you had already done some revaluation. So this is a second time revaluation. Second time revaluation is going downward. You already have revaluation reserve. You need to reverse that. You need to reverse that. What will be your entry? Revaluation reserve account debit to fixed asset 2 lakh, 2 lakh. The original asset which was 35 will now become 33. Your revaluation reserve which was 3 lakh will now remain 1 lakh in your accounts. Let's come down to case C. What is case C saying? Case C is saying the revalued amount is equal to 31 lakh. Case C, book value of the asset is 35 lakh. Revalued amount is equal to 31 lakh. Now everyone try to think and tell me, revaluation is upward or downward? It is a revaluation downward. What should I record? Sir, can we record revaluation reserve to fixed asset? Yes, because you're reversing the previous revaluation. How much will you reverse? 35 has to become 31. Yeah, 35 has to become 31. So how much I have to reverse? 4 lakh. Can I reverse 4 lakh? No, sir. Why I cannot reverse 4 lakh? I cannot reverse 4 lakh because 4 lakh is not there in revaluation reserve account. The original amount in revaluation reserve account existing is only 3 lakh. So to the extent of 3 lakh, I will reverse. What about the balance 1 lakh? Balance 1 lakh will be taken from your PNL account. This is what I mean by saying to the extent of previous reversal. Previously 3 lakh was recorded. To the extent of 3 lakh, I will reverse. Balance 1 lakh I will take to my PNL account. Sir, in the case B, why I did not do PNL account? Because the reversal was only 2 lakh. Original amount in RR was 3. To the extent of 2, I can take. If it is more than 3, then I will go to my PNL account. In this way, revaluation upward and downward will be recorded along with consideration of previous reversal. I hope this is clear. We have discussed change in method of depreciation, change in useful life, revaluation of an asset. Now let us see depreciation on the revalued asset. Depreciation on the revalued asset, I think it is illustration number 12. Let me just see one moment. Yes, it is illustration number 12 itself. Let us come down to illustration 12 of ICI material. A machine costing 12 lakh is depreciated on straight line basis, assuming 10-year working life. Okay, zero residual value for 3 years. After third year, at the end of third year, the machine was revalued upward by 60,000 and remaining useful life was reassessed as 9 years. So what is this question dealing with? Marked in green color on the screen, it is dealing with revaluation of an asset and change in useful life. Sir, why change in useful life? After 3 years, remaining should be how much? 7. Here the remaining life is reassessed as 9. So total life has become 12 years. What to do in such a case? In such a case, we will go ahead for calculation of depreciation. I will go ahead to say this is solution to question number 12 of ICI material itself. Cost of the asset is 12 lakh. Scrap value, I think, is given as nil, zero residual value. Yes. Original life is estimated to be how much? Original life was estimated to be 10 years. What they are changing? They are having a change after year 3 in the cost. There is a revaluation upward of 60,000, and after year 3 your remaining useful life is given as 9 years. Based on this, let us calculate your depreciation. Question has told to calculate depreciation for fourth year. Of course, we need your depreciation for year 1 to year 3 as well. Depreciation from year 1 to year 3 kitna? 12 lakh minus 0 divided by 10. 1,20,000 per annum. 1,20,000 depreciation per annum. What would be WDV at the end of year 3? 12 lakh minus 1,20,000 into 3. 12 lakh minus 3,60,000. That will give you how much? That will give you 8,40,000 as your WDV. Now this 8,40,000, can I depreciate for 9 years? No. At this point of time, there is a revaluation. What is the revalued amount of the asset? 8,40,000 was the WDV. There is a revaluation third of 60,000. So now the remaining amount is 9 lakh. Depreciation for year 4 will be equal to 9 lakh divided by 9 years, 1 lakh rupees per annum. In fact, from year 4 onwards, it will be 1 lakh per annum. That's the same answer given in your ICI material as well. We've discussed miscellaneous topics for depreciation. One, change in life of the asset, change in method of depreciation, revaluation of an asset, depreciation on revalued component, depreciation on the revalued asset. Remember to do the theory topics as well. You have objectives of depreciation, you have depreciation on parts of an asset, and amortization as well. Lot of theory points to be kept in mind for amortization. Cost of an intangible asset, useful life of an intangible asset. Useful life, there is an assumption that it cannot cross 10 years unless there is an evidence available. So these theory points can come as a true or false question in the exam. Along with this miscellaneous topics, also make sure to go through the theory for the day. With this, we have completed our target for today. Make sure you revise well before going to the exam. As always, Yashasvi Baba.